Imagine walking into a dealership and seeing your dream truck, SUV, or muscle car sitting there with a price tag that's literally 35% lower than what you expected. That's not a discount weekend. That's not some limited clearance sale. This is Stellantis shaking the ground under the entire auto industry. Ram, Dodge, and Chrysler aren't just dipping their toes into aggressive pricing. They've gone full throttle, slicing MSRP by more than a third. And the ripple effects are already making rivals nervous. Ford, GM, Toyota, every major automaker has their eyes locked on this move because it's not just about moving inventory, it's about flipping the table in a market where prices have been climbing non-stop for years. Think about it. Ram trucks have been battling Ford F-150 and Chevy Silverado for the crown of America's favorite workhorse. But now, when a Ram 1500 suddenly undercuts its rivals by tens of thousands of dollars, that decision at the dealership just got a whole lot easier. You're not only getting one of the most luxurious, tech-loaded, and capable trucks on the road, you're getting it at a price point that feels like you're stealing it. And Dodge? Oh man, Dodge is already the brand that screams value for performance. Chargers, Challengers, Durangos. They've always been the wild cards in the garage. Now, take that muscle, drop the sticker price by 35%, and suddenly owning a roaring Hemi V8 isn't just a dream for enthusiasts, it's an attainable reality for anyone ready to turn the ignition. And let's not forget Chrysler. The Pacifica has quietly been one of the smartest buys in the family market, but now, families shopping for a minivan or even a crossover SUV are about to realize they can stretch their budgets way further than before. Stellantis isn't just cutting prices, they're rewriting how families, workers, and enthusiasts think about affordability in a market where affordability felt like it was evaporating. The timing couldn't be more perfect either. Consumers are strapped, interest rates are sky high, and people have been holding back on buying new vehicles because the price tags have been nothing short of shocking. But suddenly, boom, this move lands. Stellantis is betting big that volume will crush margins, that getting people back in showrooms, back in financing, back behind the wheel of their brands is the winning long game. And here's the kicker. This isn't just about selling cars, it's about shaking loyalty. When a Ford guy or a Toyota loyalist suddenly sees a Ram or Dodge offering thousands less for equal or better features, you better believe some long-held loyalties are going to get tested. And here's where it gets even more interesting. This isn't just Stellantis tossing out a sale to clear lots. This is a straight-up market disruption strategy. Think about it. For years, automakers have trained us to believe that higher prices are just the new normal. They've used supply shortages, chip shortages, even rising material costs as the story behind ballooning MSRPs. But Stellantis just came in and ripped the mask off, proving that prices can, in fact, drop and drop hard. That message is going to echo across boardrooms in Detroit, Tokyo, and even Silicon Valley. Because when buyers start flocking to Stellantis showrooms in droves, competitors can't afford to sit back and watch their customer base erode. Now, imagine the Ford dealer down the street. A customer walks in to look at an F-150, sees the price, and then realizes a comparable Ram is sitting 35% cheaper. That's not just competition, that's a knockout punch to the gut. Same story for Chevy Silverado and GMC Sierra shoppers. Even Toyota Tundra and Nissan Titan buyers are going to feel the pull because suddenly, brand loyalty is up against real-world math, and math almost always wins. This move has the potential to create a massive wave of switching people trading in their old loyalties because the value proposition is just too good to ignore. And here's the kicker. This isn't only about trucks and muscle cars. Picture the family shopping segment. Parents trying to stretch every dollar are staring down SUVs and minivans that have crept into luxury pricing territory. But now, Chrysler, with the Pacifica, or even Dodge with the Durango, becomes the obvious smart buy. That opens Stellantis up to households who may have never considered them before. And once those buyers experience the comfort, the features, the tech, and the reliability firsthand, Stellantis isn't just making a one-time sale, they're planting seeds for long-term loyalty. But here's the question nobody can ignore. How long can Stellantis keep this up? Because yes, cutting 35% off MSRP brings in volume, but it also squeezes margins to the bone. That means Stellantis must be betting on sheer numbers, selling far, more units than they've projected, recapturing lost ground and dominating the market share race. And let's not forget, they've got global resources, scale, and a wide variety of platforms that give them a unique edge to pull this off, where other automakers might crumble under the weight of such aggressive cuts. What really gets wild is the ripple effect this could trigger in the EV market. Tesla, Rivian, and even Ford with its Lightning have been playing the premium price card. But now? If Stellantis decides to extend these cuts into their electric offerings, think Jeep 4X, Ram EV trucks, or even Chrysler's upcoming EV models, the entire EV price war could ignite overnight. Suddenly, those affordable EV promises might finally have to be kept, because Stellantis just moved the goalposts for everyone. And if Stellantis really leans into the EV disruption angle, the shockwaves will be massive. Right now, one of the biggest complaints about electric vehicles is simple. They're just too expensive for the average buyer. Sure, there are tax credits and incentives, but when you see $60,000 price tags slapped on vehicles that are supposed to be the future of affordability, it leaves a lot of buyers on the sidelines. But what happens if Stellantis brings that 35% cut mentality to its EV lineup? Suddenly, that futuristic Chrysler EV sedan or the Ram 1500 Rev truck isn't just competing with Tesla on range or charging speed, it's completely blowing them out of the water on price. And that changes the narrative entirely, because affordability is the one lever that can flip EV hesitation into EV adoption almost overnight. Now, think about Tesla. For years, Tesla has had the freedom to adjust prices at will because no one was undercutting them in a meaningful way. But if Stellantis puts out an EV that's not only competitive but also thousands of dollars cheaper, that forces Tesla into a position they've rarely been in defense. Elon Musk can't just tweet his way out of that. He'd have to respond with price cuts of his own, and that domino effect spreads across Ford's Lightning, Chevy's Silverado EV, Rivian's R1T, even luxury players like Lucid. Suddenly, what was once a high-margin segment turns into a battlefield for who can deliver the most value at the lowest price point, and Stellantis is standing there with a head start. But here's the crazy part. This move isn't just about cars. It's about perception. For years, consumers have been trained to expect pain when walking into a dealership. Sky-high prices, hidden fees, insane monthly payments. Stellantis just turned the script upside down. They've created a moment where buyers who thought new car was out of reach suddenly feel like it's possible again. That psychology shift is dangerous for competitors, because once people see Stellantis as the brand that makes cars affordable again, it's very hard to put that genie back in the bottle. And the pressure doesn't stop there. Dealerships across the country are about to be tested. Stellantis dealers are going to be swamped with foot traffic, with people wanting to see if the hype is real. And if the lots are full and the deals are legitimate, those buyers are driving home in Dodges, Rams, and Chryslers. Meanwhile, Ford and GM dealerships will be standing around explaining why their trucks and SUVs cost $15,000, $20,000, even $25,000 more for the same class of vehicle. That awkward conversation will play out thousands of times, and every single time, Stellantis gains another customer. And let's not forget, loyalty isn't what it used to be. This isn't the 1970s or 80s where people swore allegiance to one automaker for life. Today's buyers chase value, features, and practicality. If Stellantis proves they can deliver all three while slashing the sticker shock, this becomes more than just a pricing strategy, it becomes a market reset. And once Stellantis resets the bar, every competitor will be forced to follow, whether they like it or not. And here's where the squeeze really starts to hurt the competition. Ford and GM can't just ignore this. Their entire business models rely heavily on truck and SUV profit margins. Trucks like the F-150 and Chevy Silverado aren't just bestsellers. They're lifelines, pumping billions into the balance sheets. But if Ram suddenly undercuts them by 35%, those fat profit margins evaporate. Ford and GM have to make a choice. Either slash their own prices and risk cutting into their golden goose, or hold the line and watch buyers defect to Stellantis. Neither option is comfortable, and that's exactly why this move is so dangerous for the incumbents. And then you've got the ripple effect in financing. Think about what a 35% lower MSRP actually means for monthly payments. If a $60,000 truck drops down into the low $40,000, that's a shift of hundreds of dollars a month for the average buyer. In today's economy, with interest rates sky high and wages stretched, that difference is life-changing. Suddenly, people who were priced out of the new car market completely are right back in the game. Leasing becomes cheaper, financing feels less like a ball and chain, and buyers who were about to settle for a used car are now reconsidering a brand new Ram, Dodge, or Chrysler. But it doesn't stop there. Used car prices are about to get hammered. Over the last few years, used cars have been inflated to ridiculous levels, with some buyers paying more for a 2-year-old vehicle than its original sticker price. That bubble was already starting to wobble, but Stellantis just shoved a pin straight into it. If new vehicles are suddenly thousands cheaper, the justification for buying used collapses. That means dealerships sitting on inflated used car inventory are about to feel real pain, and buyers who waited on the sidelines, they're about to pounce on new instead of settling for old. And here's the subtle genius behind Stellantis' move. They're not just fighting today's battle. They are setting themselves up for tomorrow's war. By dragging millions of buyers back into showrooms with irresistible prices, they're filling garages and driveways with Stellantis vehicles. That means future trade-ins, future loyalty, future brand recognition, all snowballing over the next decade. Meanwhile, competitors are scrambling to react, losing ground not just in sales numbers, but in long-term customer pipelines. The big question everyone's asking is, how sustainable is this? Can Stellantis keep chopping 35% off the top, or is this a strategic, time-limited blitz to shake up the market before adjusting back? Because if it's permanent, we're looking at a total restructuring of the industry. If it's temporary, Stellantis might still walk away with millions of conquest sales and a ton of momentum. Either way, the automotive market we knew before this move is gone, the landscape has shifted. And buyers know it. And what comes next could be the real storm. Because as Ford, GM, and even Toyota scramble to defend their turf, they'll have to pull levers they don't want to pull. Incentives, rebates, financing deals, maybe even their own MSRP cuts. The result? A price war that could spiral across the entire industry, leaving Stellantis smiling while everyone else scrambles to keep up. And you better believe Wall Street is paying attention to this. Investors live and die by margins, by predictable earnings reports, by steady cash flow. So when Stellantis comes out swinging with a 35% slash in MSRP, the first reaction is shock because conventional wisdom says lower prices mean weaker profits. But here's where the story gets really interesting. If Stellantis pulls massive volume, if they flood the roads with Rams, Dodges, and Chryslers, those lower margins might actually balance out with raw sales numbers. Think of it like Walmart's strategy: stack 'em high, sell 'em cheap, dominate the market. And if Stellantis proves this works in autos, Wall Street will have no choice but to take them seriously as the disruptor brand in a stale, overpriced industry. Now, for Ford, GM, and even Toyota shareholders, the mood could flip darker. Imagine being an investor watching Stellantis rake in volume while your company clings to high prices and loses buyers every quarter. Stockholders hate watching market share vanish, and they're going to start pressuring those companies to respond fast. That could mean cutting prices, slashing costs, even accelerating layoffs or plant restructures to survive. Suddenly, this isn't just a pricing battle, it's a boardroom war, fought with shareholder pressure and Wall Street expectations breathing down CEOs' necks. Meanwhile, let's talk about the everyday buyer, because at the end of the day, this is who really wins in the short term. Over the next 6 to 12 months, the car market in America could feel like a fire sale. Stellantis' bold move forces discounts, rebates, and financing offers from everyone else. Shoppers who were waiting, holding out for the right time, are going to find deals they haven't seen in over a decade. A family that was budgeting for a used crossover might suddenly drive home in a brand new Chrysler Pacifica. A contractor who thought a full-size truck was out of reach could finally park a Ram 1500 in their driveway. This isn't just affordability, it's access, and that's what makes the move so seismic. But don't get it twisted, it won't all be smooth sailing. With that much demand crashing into Stellantis showrooms, expect shortages, wait lists, and possibly even dealer markups sneaking back in. If buyers flood the lots faster than Stellantis can ship cars, we could see supply crunches, and that's where things get messy. The company will have to prove it can scale production at the same pace it's slashing prices, or risk losing momentum when buyers get frustrated. And beyond that, there's the looming question of sustainability. Can Stellantis maintain this aggressive posture for the long haul? Or is this a calculated shock meant to jolt the market, grab headlines, and lock in buyers before slowly creeping prices back up? Because make no mistake, if this strategy sticks, it rewires the DNA of the entire car market. If it doesn't, it could be remembered as the most audacious but risky gamble in modern auto history. And here's where it gets even more complicated, because government regulators, unions, and supply chains are all going to feel the tremors of this Stellantis bombshell. Think about regulators for a second. Washington has been talking non-stop about affordability, about how the average new car price has gotten so out of control that most Americans are priced out. Now Stellantis just handed them a living, breathing example that those sky-high prices weren't inevitable. If one automaker can chop 35% off the top, expect policymakers to start asking tough questions of the rest. Why haven't Ford, GM, Toyota, and others done the same? That kind of political pressure could turn this pricing move into a wider debate about fairness, competition, and even consumer protection. And then you've got the unions, especially the UAW, which just fought hard for massive pay raises and better benefits. Cutting MSRPs that aggressively means Stellantis has to be surgical about efficiency. That could put strain on labor negotiations, plant operations, and long-term job security. If Stellantis can pull it off without trimming their workforce, they'll look like geniuses. But if margins tighten and labor costs climb, we could see tension flare between the company and the union. That's a powder keg, because labor disputes can slow production. And slowing production is the one thing Stellantis can't afford right now if they're going to flood the market with affordable cars. Now, let's zoom out to the global supply chain. Every bolt, every chip, every sheet of steel has to be sourced, and suppliers are already stretched thin. If Stellantis suddenly ramps up demand by tens of thousands of extra units a month, suppliers will either have to scale with them, or Stellantis risks bottlenecks that choke the entire plan. And remember, suppliers love fat margins too. If Stellantis is selling cheaper cars, you can bet suppliers will be under pressure to deliver parts at even leaner costs, which could ripple all the way down to factories in Mexico, Canada, Europe, and Asia. The domino effect is staggering. But here's the raw truth. The everyday buyer doesn't care about supply chains or union negotiations. They care about one thing. Can I get that Ram, that Dodge, that Chrysler at the price Stellantis is promising? And if they can, then everything else, regulators, unions, Wall Street, suppliers, becomes background noise. Because once people start driving home in those aggressively priced vehicles, the perception shift is locked in. Stellantis becomes the hero brand, the one that brought sanity back to car prices in a world that was running wild. And don't forget, dealer chaos is only just beginning. The same dealerships that once leaned on inflated markups and market adjustments are suddenly in a different world. They'll have showrooms flooded with buyers, phones ringing off the hook, financing managers juggling applications non-stop. Some dealers will embrace it, playing the long game of volume sales, while others might resist, looking for ways to sneak profit back in. That's where Stellantis will have to police its own dealer network, making sure the promise of affordability actually reaches the buyer instead of getting lost in hidden fees or shady practices. If they can enforce that, the trust they'll build with buyers could become the most valuable weapon in their arsenal. And that's exactly where Stellantis has a golden opportunity, because in the middle of all this dealer chaos, trust is the real prize. Buyers have been burned for years by endless markups, bogus add-ons, and finance managers who push monthly payments higher than advertised. If Stellantis steps in and says, no games, no gimmicks, this is the real price, 35% off MSRP, period, then they don't just sell cars, they build loyalty. And loyalty in today's auto market is worth more than horsepower, more than fuel economy, more than tech features. Trust is currency, and Stellantis has a chance to cash in big. Now, let's talk psychology, because this is where the shift gets explosive. Imagine you're a Ford or Chevy owner who just paid full price for your truck a year ago. Suddenly, you see your neighbor drive home in a brand new Ram that's not only cheaper than what you paid, but also has better features, better tech, and better comfort. That's a gut punch. Buyers start feeling like they've been ripped off, and that resentment doesn't just stay with them, it spreads through conversations at work, at the gas station, at family gatherings. Stellantis isn't just cutting prices. They're planting seeds of doubt in rival customers' minds, and once doubt sets in, brand loyalty begins to crack. That's dangerous for Ford, GM, Toyota, because their entire playbook depends on keeping buyers locked in generation after generation. But Stellantis just showed the world that loyalty doesn't matter if the price gap is wide enough. Even lifelong Ford guys, even die-hard Chevy families start looking across the street when they realize they can save tens of thousands. It's not betrayal, it's math. And in a time when wallets are tight, math wins. But here's the kicker. This isn't just a short-term sales play. Stellantis is essentially resetting what buyers believe a car should cost. Once you anchor consumers to a new, lower-price reality, every other brand that refuses to match it suddenly looks overpriced, greedy, or out of touch. That's a psychological reset that competitors will struggle to overcome, no matter how strong their marketing or how shiny their new models are. And speaking of marketing, this move is going to turn every Stellantis commercial into dynamite. Imagine the TV spots. Why pay $65,000 for their truck when you can drive away in a Ram for $42,000 today? Or billboards plastered with giant 35% off MSRP numbers. The message is simple, brutal, and impossible for buyers to ignore. Competitors can brag about horsepower, towing, or luxury, but when Stellantis is bragging about giving people their money back, it cuts deeper. And that brings us to the nuclear option, because if Stellantis decides to combine these insane price cuts with aggressive financing, 0% loans, or extended warranties, it's not just a sales pitch anymore. It becomes the ultimate value package, the kind of offer that makes buyers feel stupid for shopping anywhere else. That kind of layered attack could completely rewrite the playbook for how cars are sold in America. And here's where the long-term picture comes into focus, because Stellantis isn't just playing for today's headlines, they're laying the groundwork for the next 5 to 10 years of the auto industry. By resetting prices, they're rewriting buyer expectations for an entire generation. Kids growing up right now are watching their parents drive home in Rams, Dodges, and Chryslers at prices that used to be impossible. When those kids grow up and buy their first car, guess which brands will already be burned into their idea of value and trust? Meanwhile, Ford, GM, and Toyota will be forced to make hard choices. They'll either adapt and join the affordability revolution, or they'll cling to inflated margins and risk fading into irrelevance. If they slash prices, profits take a hit. If they don't, market share slips away. Either way, Stellantis has them cornered, and that's a position no one saw coming a year ago. Over the next decade, the ripple effect could be enormous. Lower entry prices mean more cars on the road, more buyers upgrading sooner, and stronger brand ecosystems for Stellantis to build around. Their upcoming EVs. Instantly more appealing if they carry the same affordability DNA. Their global lineup. Positioned to dominate in regions where affordability isn't just a perk, it's survival. And here's the ultimate takeaway: Stellantis has done something no automaker has dared to do in the modern era. They put the power back in the buyer's hands. They reminded the world that cars don't have to cost a fortune, that value still matters, and that loyalty is earned through fairness, not forced through scarcity. This isn't just a price cut, it's a market reset. So buckle up, because the next time you drive past a Stellantis lot, you're not just looking at trucks, minivans, and muscle cars, you're looking at the spark that might have just ignited the biggest shift the auto industry has seen in decades. And whether you're a buyer, a dealer, or a competitor, one thing is certain: the road ahead just changed forever.